over a trading strategy that just involves the use of price action and the Fibonacci retracement tool. So here is the strategy as follows. First, you're going to want to identify a flag consolidation pattern, and there's two types of flag patterns that you're going to be wanting to look for. For the bullish flag, you're going to be looking for a strong bullish move followed by parallel trend lines that create for a flag-like shape pointing into the downward direction. For bearish patterns, you're going to be looking for a strong impulsive bearish move followed by parallel trend lines that point into the up direction. After you identify this pattern, you're going to want to pull out your Fibonacci retracement tool to mark the proportions of the consolidation period. Remember, when you're using the Fibonacci retracement tool, you are always going to be plotting from left to right using the relative high or low, depending on if it's a bullish or bearish flag. For bullish flags, you're going to want to use the consolidation high as the first point and the consolidation low as the second point. For bearish flags, the opposite is to occur where you're using the consolidation low as the first point and the consolidation high as the second point. For our entry, this is going to confirm when price closes through the 0.707 level of retracement. Now, what I mean by closing through, a candlestick must close through the level on the same time frame that was used to identify the flag pattern. And if there's no confirmation, meaning that there's no candlestick that closes through the level, and we just simply get a price movement through the level with no candlestick close there, then you do not enter the trade. For the stop loss, you're going to want to go ahead and set this at the 0 level of retracement. So if the 0 level of retracement is broken after we see a confirmation of the 0.707 level, then that will result in you stopping out of the position. And this is going to be a hard stop. So that means that any price movement that occurs through the level will automatically stop you out of the position. We're not looking to use a candlestick close in this case. And finally, for price targets, we're going to look at the 1.414 and 1.618 levels of retracement as your price targets. And what you're pretty much going to do is just sell half of the position at the 1.414 level and sell the rest of the position at the 1.618 level. All right, so let's go ahead and go through this trading plan using TradingView. So let's look at and see if we can identify the flag pattern. First, we have a strong bullish move followed by consolidation. And if I just go ahead and take some trend lines to this consolidation period, you'll notice that we do get those parallel trend lines that occur into the downward direction. So this would be a bullish flag. Now, the second thing that we're doing after we identify the bullish flag pattern is pulling out our Fibonacci retracement tool, which can be found here. And since this is a bullish flag, we're going to go from the consolidation period high to the consolidation period low. Now, you'll notice that the points that I have set here are at the 0 level, 0.707, and then our two price targets at the 1.414 and 1.618 levels of retracement. If you want to get these levels on your screen, go ahead and move to the settings tab and select the ones accordingly. You will have to add in the 0.707 level because that is not one of the ones that is automatically preset into TradingView. So after you have those gone ahead and set up on your screen, go ahead and select OK. And now we are ready to establish our trade. So how are we going to go about this? Well, remember the 0.707 level is our entry point. So I'll go ahead and draw out our entry there. This will be our entry point right here. And then we're going to use the 1.414 and 1.618 as price targets. So I'll go ahead and draw those out there. And then our stop loss is going to be at a move below the 0 level. So if we get a move below the 0 level here, and let me just actually make this a bit red, then this would be our stop loss. So let's go ahead and watch this play out and see how we would make play using the strategy that we have identified. So let's go ahead and play this out. And on this green candlestick right here, notice we're still on the 5-minute chart, which is what we use to identify the flag pattern on. We get a candlestick close above the 0.707 level. This is going to tell us to go ahead and identify an entry. So now we have entered a position here. And the specific option contracts that I would be buying, since I'm looking at the NQ futures, this would correspond to the QQQ. Remember, whenever you're trading, say something like the QQQ or SPY, it's better to chart the derivative of the future because it just has a bit more liquidity. So if I'm looking at this chart on NQ, I would go ahead and buy QQQ call options at the money, which means that whatever price is currently at for the QQQ is the strike price that I would buy. And since I'm on the 5-minute chart, I would either go with the 0-day expiration, 1-day expiration, or 2-day expiration, depending on how much you want to risk. But anyway, we are now in the position and we have a stop loss at the pattern low, and our take profits are at the 1.414 and 1.618 level. So let's go ahead and play this out. We are currently in the position now. And we do get some fluctuation there, but now it looks like we're approaching our price target. And on this green candlestick right here, the one that touched the 1.414 level, I would sell half of the position right then and there, and then leave the other half of the position to run to the 1.618 level, all while keeping that stop loss below the 0 level. Notice just a couple candles later, we actually do get the move to the 1.618 level, which is where we would sell the rest of the position at and look for the next play to go ahead and take. All right, let's go ahead and look at another bullish flag setup here. This time we're looking at the NVIDIA 3-minute charts. And first of all, we have that strong bullish impulse move followed by a period of consolidation. And if we just draw out the period of consolidation that is occurring here, we'll notice that we have those two parallel trend lines that point into the downward direction. So this would, of course, be a bullish flag. And the reason why it's called a flag is because this would be like the flagpole right here, and this is the flag-like shape. Notice it kind of resembles the shape of a flag. But anyway, let's go ahead and pull out our Fibonacci retracement tool. And remember, we're looking at a bullish flag, so we're going to go from the pattern high to the pattern low. And now we have identified our point of entry and our 2 points of exit. So for our entry point, remember, we're going to want to see a candlestick close above the 0.707 level. So if we can get a candlestick close above the 0.707 level here on the 3-minute time frame, which is the time frame that we use to identify the flag pattern, then we would take a position to the upside. And since this is going to be on NVIDIA and we're looking at the 3-minute chart, would buy the weekly call options at the money, meaning whatever price that we're seeing here. And this time it is 174.5, 174.6-ish. I would look to buy, say, the 174 call or the 175 call, depending on which one has better liquidity. We have identified our entry here, and our price targets are at the 1.414 and 1.618 levels up here. And the stop loss would be with a candlestick movement, just any price movement below the 0 level of retracement. And let me go ahead and make this red so that we know to go ahead and stop out there. Let's play this out and see how we would make a move and a play accordingly. Notice here, we just get a simple candlestick wick that moves above the 0.707 level. That is not enough to constitute an entry for a trade. Remember, we want to see a candlestick close above this level. So let's go ahead and keep playing this out. And right here on this candlestick, we do get a candlestick close above the level. So we would go ahead and enter right around here, probably buying the 175 call on the weekly option. And now we're setting our stop loss at the pattern low, and our take profits are at the 1.414 and 1.618 levels of retracement. So let's play this out and see how this moves. As you can see, we actually broke through the 1.414 and 1.618 levels pretty much simultaneously within the same candlestick. So you would probably take around full profit at this point. Of course, in real time, you would have taken half the profit off at the 1.414 level and then the other half at the 1.618 level. But this just goes to show how strong of a price targets these are. We would take profit on the entire position there and look for the next setup without looking back. And the reason why we're not using higher price targets is just because these two price targets are extremely reliable with this strategy. And a lot of times what will happen is this 1.618 level will be kind of like the turning point, and we'll actually see a move occur back to the downside. And these are just very safe price targets to use whenever playing the bullish flag pattern. Of course, you can leave a runner or two to a higher price targets if you would like, but these two price targets are very consistent and tend to get the job done. And guys, remember, just don't be too greedy whenever you're making whenever you're making trades. It's always best to be consistent with your trading, stick to your plan, and not look back after you've entered and exited a position. Of course, look back to see what you did right and wrong, but don't look back and think of what could have been, because that is going to be a bit hard on your emotions. And that is just always something to remember whenever you're trading. But anyway, now let's go ahead and look at some examples of the bearish flag pattern. So this time we're seeing a strong bearish impulsive move followed by consolidation. And if I just tack on some trend lines here, you'll notice that this time we have those two parallel trend lines that are pointing into the upward direction, giving us that bearish flag shape. Notice we have the bearish flagpole and then a flag-like pattern. And notice it's kind of like an upside down flag. This is pretty much going to be played the exact same way. It's just a little bit flipped. So if I pull out the Fibonacci retracement tool, I would go ahead and mark my first point at the pattern low this time and second point at the pattern high. Now we have identified our point of entry and our point of exit, as well as where to identify a stop loss. So let's go ahead and draw those out. We would have our entry with the candlestick close beneath the 0.707 level, and then set our price targets at the 1.414 and 1.618 levels down here. And of course, our stop loss would be with any price movement above the 0 level of retracement. And I can just make that red to let me know that this is the stop loss level. For options trading specifically, this is the S&P 500 E-mini futures. And as I mentioned before, we chart the derivative futures and then we trade the SPY option. So this would correspond with SPY. So I would look to buy SPY options at the money if this level was to be broken and the close was to occur beneath it on the 30-minute time frame. And you'll notice that we are using a bunch of different time frames here. And this is just going to show that this strategy works on all different time frames and can be applied pretty much to any different time frame, whether you're a swing trader, a long-term investor, or even a day trader / scalper. But anyway, let's go ahead and play this out and see what occurs. So on this candlestick right here, that closes beneath the 0.707 level, we're going to take an entry to the downside. So we'd be buying a put contract at the money, setting our take profit at the 1.414 and 1.618, and our stop loss at the 0 level of retracement. So if I go ahead and continue playing this out, notice we would get a very quick and clean move to the 1.414 level, where we're looking to take profit on half of the position and leaving the other half of the position to run to the 1.618 level. And see, we actually do get that move to the 1.618 level right here, where we would sell the rest of the position and not look back at all, taking our profits and just looking for the next setup. All right, let's go ahead and take a look at one more setup here. This time we're looking at ticker symbol META, also known as Meta. And notice here we have that strong bearish move followed by a period of consolidation. And if I simply just draw on some trend lines to mark this period of consolidation, you'll notice that once again, we do have those parallel trend lines that point into the upward direction, and we do get that flag-like pattern. So same thing can be applied here. Pull out the Fibonacci retracement tool. This time we're going from the pattern low to the pattern high, and we have identified our entry, our take profit, and stop loss. So if I want to go ahead and mark those out here, we would take an entry with the candlestick close right here beneath the 0.707 level, set our take profit at the 1.414 and 1.618 level, and then of course set the stop loss with the candlestick movement through the 0 level of retracement. And I can make that red just so it's a bit more clear. So now we have identified our entire trading strategy, and we can play this out to see what occurs. So on this next candlestick, actually, we get a candlestick close through the 0.707 level here. We're going to take a put, which is an entry to the downside. And since we're at the 166, 167 level, we would look to buy at the money put options, which would be around the 166 or 167 strike price, depending on which one has better liquidity. Now we're going to go ahead and make this play, setting our stop loss above the 0 level of retracement here, and our take profits at the 1.414 and 1.618 levels of retracement. So if you look right here, you'll notice that we actually do get a candlestick that touches the 1.414 and 1.618 levels of retracement. So you would look to go ahead and take profit in real time when we get a touch along that 1.414 level, where we would take half the position off the table and then sell the other half at the 1.618 level. If I go ahead and continue playing this out, the reason why we use the 1.618 and 1.414 level really shows here. Notice that we do get a reversal directly off of this 1.618 level, which would have actually seen a move occur all the way to the stop loss region, which is why I'm saying don't be too greedy whenever you're trading with this strategy. And the 1.414 and 1.618 level are extremely consistent levels. And the name of the game is just sticking to your plan. But anyway, guys, thank you for watching. And that is the flag pattern trading strategy that strictly relies on price action